What if the $7 trillion AI boom isn't real? Right now, the stock market is placing a multi-trillion-dollar bet on artificial intelligence. The valuations are staggering. Nvidia, Microsoft, Apple, Alphabet, Amazon, just a handful of companies now make up an insane percentage of the entire S&P 500. If you have a 401k, you are no longer a diversified investor. You are a concentrated AI gambler, whether you like it or not. The market tells us this is justified by explosive revenue growth. Nvidia's sales are vertical. Microsoft's cloud business is exploding. The numbers look undeniable. But what if I told you that a huge portion of this growth isn't coming from new, happy customers buying a new product? What if it's all just a closed financial loop, a multi-trillion-dollar shell game played by 3 or 4 of the biggest companies on Earth? This is the story of the circular financing loop, and it's the most important and most dangerous story in finance right now. To understand what's happening, you need to forget everything you think you know about how a business works. Normally, a company creates a product, let's say a shovel. A customer, a gold miner, buys that shovel to dig for gold. The shovel company makes money. The miner, hopefully, finds gold. That is real economic activity. New value is created. The AI economy is not working like that. It's working like this. Step 1. The investment. It starts here. Microsoft, along with other venture capitalists, invests a massive sum, let's use their very real $10 billion investment, into OpenAI, the creators of ChatGPT. OpenAI is now rich. It has $10 billion in the bank. But what does it need to run its incredibly complex models? It needs computing power, a lot of it. Step 2, the cloud spend. So OpenAI turns around and signs a massive multi-billion-dollar contract with Microsoft to use their Azure cloud services. Now stop and look at the books. OpenAI's bank account hasn't really changed, but Microsoft's Azure division just reported a massive surge in revenue. Their earnings call sounds incredible. Analysts are thrilled. The stock price goes up, but no new money has entered the system. It was just an investment immediately reclassified as revenue by another division of the same company. But it gets even better. Step 3, the GPU purchase. To power all that new cloud demand from OpenAI, Microsoft needs hardware. They need the most advanced graphics cards on the planet, and only one company makes them. So Microsoft takes that revenue it just got from OpenAI and places a $10 billion order for GPUs from Nvidia. Now Nvidia's earnings are astronomical. Their CEO, Jensen Huang, is on every magazine cover. Their sales have grown 100%, 200%. The company's valuation soars past $3 trillion. It's a miracle. Do you see what happened? That same $10 billion, which started as Microsoft's investment, has now been counted as revenue by Microsoft's cloud division and as revenue by Nvidia. In this single loop, $10 billion in capital has magically created $20 billion in economic growth and revenue that analysts and your 401k are betting the farm on. This isn't a shovel and a gold miner. This is a company paying its customer so that customer can pay it back so it can then pay its supplier. It's the IOU skit from the Three Stooges, but for the entire global economy. Now, you might be thinking, okay, but that's just one example. But it's not. This is the entire model. This is called CapEx, or capital expenditures. In 2025, those same AI tech companies are set to spend $330 billion to build data centers and buy GPUs. Where is that $330 billion coming from? Is it coming from millions of new customers buying AI products? No. A huge chunk of it is coming from this same loop. Nvidia itself has a venture capital arm that invests in AI startups. What do those startups immediately do with the money? They spend it on Nvidia GPUs. Nvidia invests, the startup buys from Nvidia, Nvidia's revenue goes up, the startup's value goes up. It is a perpetual motion machine, and it has a massive problem. The entire loop is being funded by debt and venture capital, not from profits from real pay-in customers. And this debt is hidden. It's not sitting cleanly on the balance sheets. It's being run through private credit, structured vehicles called SPVs, and joint ventures. The reality is, to actually justify their current stock prices, these AI companies would need to make around $2 trillion a year in real revenue. To put that in perspective, in 2024, Apple, Amazon, Microsoft, Meta, Nvidia, and Google combined did not make $2 trillion. The market has already priced AI as if it's the biggest money-making engine in human history before it has even made any significant money. That, my friends, is a major red flag. So why are the smartest people in the world doing this? Are they insane? No. It's incentives. Motive 1. The narrative. Stock prices are not driven by reality. They are driven by a narrative. And the most powerful narrative in the market today is AI growth. As long as Nvidia and Microsoft can post 100% revenue growth, even if that revenue is just coming from their own pocket, the narrative holds. The stock price goes up, their market cap increases, and that new, higher stock price gives them even more power and capital to keep the loop going. Motive 2. Too big to fail. There is another, darker motive. The race against China. The CEOs of these companies know exactly how important their industry is to national security, and they know the U.S. government will do anything and everything to make sure America wins the AI race. Listen to Sam Altman himself when asked how his company could possibly afford the $1.4 trillion it wants to spend. At some level, when something gets sufficiently huge, the federal government is kind of the insurer of last resort. Did you catch that? The insurer of last resort. When the market heard this, they reacted. Wait, are you asking for a bailout? He's not so subtly hinting that his company is now so strategically important it can't be allowed to fail. By inflating themselves with this circular, debt-fueled spending, they are making themselves too big to fail. If AI spending slows down, the U.S. economy slows down. If the economy slows down, markets fall. If markets fall, there will be immense political pressure to save these companies at all costs. The people running these companies are smart, but the people who aren't playing the game are even smarter. When a bubble is forming, the first thing I do is look at what the sharks, the old money value investors, are doing. And they are terrified. Red flag 1, Warren Buffett. Warren Buffett, the most successful investor in history, has just sold off billions of dollars of stock. He is now sitting on the biggest cash pile in the world. This isn't because he doesn't know what to buy. It's because he looks at the values in the market and sees nothing but risk. He doesn't like the prices. He is patiently waiting for the crash. Red flag 2, Michael Burry. Michael Burry, the man who predicted the 2008 financial crisis, just filed his 13F form. It shows what his fund is investing in. And what is he doing? He has put 80% of his entire portfolio into bets against Nvidia and Palantir. Let me repeat that. The guy who spotted the last once-in-a-lifetime bubble is betting almost everything he has that this AI bubble is next. Buffett and Burry don't agree on almost anything. One is a value investor, the other is a macro contrarian. But right now, at the exact same time, they are both screaming the same thing. The market is priced for a future that doesn't exist. So here's the reality. This circular financing loop is incredibly powerful, but it's also incredibly fragile. It's a Jenga tower. It can only stay standing as long as everyone keeps adding new blocks. It only works as long as one, venture capitalists are willing to burn billions on unprofitable startups. 2, interest rates are low enough to make the debt cheap. 3, the narrative of infinite growth continues. But what happens when one of those things stops? What happens when the VCs finally run out of money? What happens when investors, like Michael Burry, start to question the revenue numbers? What happens when a competitor, like AMD, finally catches up to Nvidia and margins collapse? The loop breaks. And it doesn't just slow down, it reverses. The revenue that was just an investment suddenly vanishes. The multi-trillion-dollar valuations built on that revenue collapse. And the index funds, the 401ks and the pension plans that were forced to buy these stocks all the way to the top, they get wiped out. We have seen this before. In 2000, the narrative was the Internet. The Internet did change the world, just like AI will. But that didn't stop the NASDAQ from losing 80% of its value. It didn't save the investors who bought Cisco at the top. The dot-com bubble popped. The Internet became the future. The AI bubble will pop, and AI will become the future. The question isn't if this $7 trillion loop will break. The question is when. So what am I doing? Look, I'm not the trading type. I'm not selling everything and shorting Nvidia like Michael Burry. I'm also not betting my entire life savings on it. I'm doing what Buffett is doing, in my own small way. I'm saving cash. I'm not borrowing money to invest. I'm reinvesting dividends from real companies that make real profits. And I'm watching this whole thing from a very, very safe distance. Because when the music stops, I don't want to be the one left holding the bag. Let me know what you think. Is this a real boom, or is it the biggest, most complex bubble in history? Let me know in the comments. Thanks for watching.